Hi, my name is John Palmer, Senior Vice President and Head of Real Estate Strategies for Westwood. I wanted to take a couple minutes to share my thoughts on the REIT market for the month of January, but as usual, I'll preface my REIT industry comments with some quick observations about the macro environment. January started the year off strong as far as markets are concerned, with the S&P 500 index finishing up 1.45% and the Nasdaq finishing up just under 1% for the month. Investment grade credit was up 11 basis points for January, and high yield did even better at up 48 basis points. We'll go deeper into the REIT performance a little later in the video. On the economic side, lots of questions remain. While we are still waiting for the Q4 GDP print to come out, which should happen next week, the December unemployment rate decreased to 4.4%, down from 4.6% in November. Yet the labor market remains cooler than a few years ago as wage growth has moderated and firms are simply not hiring as much. On the inflation front, the December reading came in at 2.7%, which matched the previous month. Importantly, core inflation, which excludes food and energy, came in slightly lower at 2.6%. So while the annual rate remained steady, core inflation hit its lowest point since 2021, below analyst expectations. Shifting to monetary policy, the Fed decided to pause cutting interest rates at their January meeting, maintaining the target range for the overnight Fed funds rate at 3.5 to 3.75%. Perhaps more important than the pause on rates, President Trump finally announced Kevin Warsh as his pick to take over for Chairman Jerome Powell when his term ends in May. The markets have generally had a positive reaction to this announcement, even though Warsh has more of a hawkish disposition and has been critical of various Fed actions in the past. Obviously, time will tell how this transition goes. With that macro commentary behind us, let's move on specifically to real estate. On the first slide, we show the 10-year Treasury chart since the end of 2024. The 10-year started 2026 at 4.17% and ended January at 4.24%. So we saw a slight backup in rates for the first month of the year. Switching to REITs, on the next chart, you'll see the January performance for the MSCI US REIT Index. Generally speaking, REITs started off the year strongly, posting a positive 2.8% return, significantly outperforming the S&P 500 and Nasdaq. Next, I thought it would be helpful to put the January performance in context with the broader market. On the next chart, I have broken out the S&P 500 into its 11 GIC sectors. As you can see, the REITs in the S&P 500 produced a middle of the pack return for the month of January, which is a lot better than their bottom of the pack performance for the full calendar year 2025. On the next chart, we highlight the January REIT market performance by property sectors. January was a fairly strong month for REITs, with 13 property sectors positive for the month and only 4 sectors negative. Top performers were timber, net lease, specialty REITs, data centers, and self-storage, while single-family for rent, office, and apartments lagged for the month. Lastly, I thought it would be helpful to show the change in valuations from the beginning of the year. As you can see on this last slide, implied cap rates for the most part have remained fairly steady throughout January. However, the noticeable sectors would be industrial and apartment REITs, which have seen cap rates widen a little bit, while data centers, net lease, and self-storage REITs have seen a bit of cap rate compression. But the overall implied cap rates for the REIT market currently sit in the mid-sixes, which still remains a little wide to long-term historical averages. As always, thank you for your time, and if you have any other questions, please feel free to reach out directly to Westwood. I look forward to sharing additional updates with you in the future.